Imagine this. Two people buy the exact same house on the same day. Same price. Same bank. Same credit score. 10 years later, one of them is sleeping peacefully. The other is panicking every time interest rates hit the news. Why? Because one chose a fixed mortgage and the other chose an adjustable rate mortgage, or ARM. Today, I'll explain exactly how both work simply, clearly, so you never make the wrong choice with the biggest debt of your life. What a mortgage really is. Quick reset. Before we compare anything, let's reset one thing. A mortgage is not rent you eventually own. It's a long-term bet on interest rates. When you take a mortgage, you're locking in how much risk you carry, how predictable your payments are, and how exposed you are to the economy. Every mortgage is a trade-off between certainty and flexibility. And that's exactly where fixed versus ARM comes in. Fixed rate mortgage, the calm choice. Let's start with the simplest one. What is a fixed rate mortgage? A fixed rate mortgage means your interest rate never changes. Your monthly payment stays the same for 15, 20 or 30 years. If you lock in at 6% today, it stays 6% forever, even if rates go to 3% or explode to 12%. Why people love fixed mortgages? Predictability. Same payment every month. Easy budgeting. No surprises. Peace of mind. Inflation, rate hikes, recessions. Doesn't matter, your rate is locked. Best for long-term homeowners. If you plan to stay 10-30 years, fixed is boring but powerful. The downside, yes, there is one. You pay for safety. Fixed rates are usually higher than ARM starting rates. You might miss out if rates drop later. Refinancing costs money and effort. So fixed mortgages are like buying insurance against rate increases. You're paying extra for certainty. Adjustable rate mortgage, ARM the risky one. Now let's talk about the mortgage that sounds cheap and sometimes becomes expensive. What is an ARM? An adjustable rate mortgage has two phases. Phase 1, the teaser period, usually 3, 5, 7 or 10 years. Interest rate is lower than fixed. Monthly payments are cheaper. Example, 5/1 ARM, fixed for 5 years. Adjusts every year after. Phase 2, the adjustment period. Rate changes based on market rates. Your payment can go up, go down, or spike hard. Why ARMs exist? Banks assume you'll move, refinance, or sell before the rate adjusts. And statistically, many people do. Why ARMs can be dangerous? Here's the problem. You're borrowing money today, based on what interest rates might be later. If rates rise, your payment increases, sometimes dramatically. People lose homes not because they couldn't afford the house, but because they couldn't afford the adjustment. A real-world example. Let's make this painfully clear. Scenario: home price $400,000, loan $320,000, fixed mortgage, rate 6.5%, payment to $2,020 month, same payment for 30 years. 5/1 ARM, first 5 years 5%, payment to $1,720 a month, saving to $300 month early. Sounds great, right? Now year 6 hits. Rates jump to 8%. New payment to $2,350 month. That's higher than the fixed mortgage and completely outside your control. This is how people get trapped. They planned for today. not for future rate shocks. Who should choose fixed versus ARM? Let's settle this once and for all. Choose a fixed mortgage if you want stability. You plan to stay long-term. Your income is steady, not explosive. You hate financial stress. Fixed mortgages are boring. Boring is good. Choose an ARM only if you'll sell or refinance before adjustment. Your income is likely to rise significantly. You understand rate caps and worst-case payments. You're comfortable with risk. ARM is a strategy, not a discount. If you don't have a clear exit plan, you're gambling. The rule banks don't emphasize. Here's the rule no one explains clearly. Never choose a mortgage based on the lowest payment today. Choose based on worst case payment, longest time horizon, your stress tolerance. A house should improve your life, not turn interest rate news into a panic attack. If this video saved you from making a six-figure mistake, hit like, subscribe, and share it with someone house hunting right now. Because the wrong mortgage doesn't hurt immediately, it hurts years later. And by then, it's too late.